Good afternoon, everyone. I'm going to give it just a second here. People are popping in, and then I'll get started. All right. For those of you that showed up on time, I'm going to get started. I am excited you're here today. My name is Jon Meyer and head up the wealth management side of the business. Today, we're going to talk about tax planning 201. For those of you that attended last month, we talked about tax planning 101, which is more about the basics. Uh, Today we'll do the 201, which is much more about advanced strategies. As we get into this, I just want to remind you of a couple of things. First and foremost, everything I'm going to talk about today is going to be at a high level. Some of the stuff I'll talk about can be kind of complex. So I will encourage you to go seek help from your accountant slash financial advisor. Um, some of this stuff is unique to what financial advisors know versus just accountants. So just a heads up. And with that, I'll also remind you that there is a Q&A box in your panel. So as we go forward, if there are specific questions you have, feel free to throw them in there. If I can answer them, I will. If they're too specific to a situation, I might have to defer to maybe a follow-up call with you, but that's what we'll try to do today. I'm going to also make one last comment. Uh, Lately, I've been having some issues where I get kicked out of these webinars and I have to log back in. I don't know what's going on. So if that happens, just stick with me and I will jump back on. So with that, I'm going to jump into the real fun stuff. I love this presentation because this is the one of those topics where I get to deal with very fun tools in the toolbox. These things are used when they make sense. They aren't used all the time. And so to that extent, I'm going to talk about some fairly interesting ideas that can get complex, but that's the beauty of it. So today what I want to talk about is I'm going to start with a few slides just about what is at stake when we talk about capital gains issues, because it's a dollar number, really. Secondly, I'll jump into some ideas around deferring capital gains. Third is more about how do we permanently eliminate gains. And people may think that's kind of a weird way to say it, but that is actually a way to think about it. And then finally, some of the tools for just managing gains along the way. So today, as we get started, let me start with the simple math. From the standpoint of math, if we look at it from a perspective of what most people do, and I say most people because I've seen this all the way up the spectrum of wealth. Most people simply sell an asset, pay their tax, and move on. And if you look at it from that perspective, I'm just using an example where if you have $1 million asset and you paid 250,000 for it, you have that embedded capital gain of 750,000. If we sold today, and I'm just using approximately a 33% bracket, which would be both federal and Minnesota state tax combined, you'd pay about $250,000 in tax, which means you keep about 750. That's kind of how most people do it today. Now think about it from a different angle. What if we were able to hold that asset for 30 more years and grow it instead of selling today and then reinvesting that 750,000? Okay. The 750,000 basically grows to 4.3 million. Whereas if we didn't have to worry about that tax, leaving the extra tax money in and letting that grow with it, we get to 5.7 million. So really it is about $1.5 million difference almost, how much assets you have left at the end, depending on what's going on. Now to that extent, If you then sold the asset that you had held that long, um, that you're trying to defer the tax and then you pay your taxes, versus the one that you sold and reinvested, but then you still have to pay some tax on the back end of that too when you sell it. Here's the difference net of tax. So literally almost $800,000 difference. That's what we're talking about today. How do we do this in real life? Because I think the numbers kind of blow you away a little bit. So how do we do this in real life? As we get started, I want to start with this quick story. I like this story because it came out of the Supreme Court. Justice Louis Brandeis basically had a case way, way, way back. So look at when he served, 1916 to 1939. He had a case back then, a tax case. And he basically, in giving his opinion, stated the following. When he goes home at night, he oftentimes will take the Potomac Bridge back across the river to get into Virginia to go to his home. However, some nights when he gets out of work early and he has the time, he'll go a mile or two out of his way, and there's another bridge he can take that's free. If he takes the Potomac, he's got to pay a toll, but if he takes the other bridge, it's free. And he likened it to the whole point of tax planning. And here's his quote. For my tax evasion, I should be punished. So this was a tax case, of course. But for my tax avoidance, in this case, taking the free bridge, I should be commended. The tragedy in life is that so few people know that the free bridge even exists. I've loved this story for the past 40 years when I first heard it, because I feel like this is what we're dealing with. So today, I want to educate you on where the free bridges exist when it comes to taxing and investing. So let's start out with some basic ideas around deferral. Deferral does not mean you get rid of the tax. What it does is it defers it for the future. Now, in the future, we may end up in other ways getting rid of the tax. I will get towards the end of my slide deck towards some of those ideas. But today, let's start with just deferring. I want to talk first about exchange funds. Then I'm going to jump over to 351 conversions, and finally 1031 exchanges. You can see what these are best for. Exchange funds work for people that have a concentrated holding. Let's say you had $1 million worth of Apple stock, 3M stock, whatever. That's where this makes sense. 351 exchanges can apply to concentrated holdings, but they can also apply to just an appreciated portfolio that you want to diversify even more. And then finally, 1031s. I think a lot of people on this call may have heard about 1031s already. That's kind of a real estate play, but I want to at least talk about it a little bit. So this strategy defers your tax. These strategies defer your tax. They don't eliminate tax. Let's start with exchange funds. Basically, the way an exchange fund works is you put an asset into the exchange fund, and when you put it in, you are basically putting it in at fair market value, and therefore your cost basis goes along with it. You're putting in a certain stock. There's probably hundreds of other people putting in their certain stocks. And so what you end up with is a diversified portfolio, because at the back end of that, now you own a share of that fund, which means all those stocks are partially yours. So the trick here is then what happens? A couple things happen. You contribute into a fund, and by the way, these are partnerships, so you're going to get a K1. There's all the junk around that every year, but that is what it is. And one of the rules is you have to basically hold on to this for a minimum of 7 years if you want that diversification. And here's what I mean by that. When you first put the money in, immediately 20% of the funds are going to be sold, because they have to have, under IRS rules, a qualified non-security asset. Usually these funds just go buy real estate with that 20%. Okay. But with whatever's left, the 80%, basically what happens is You now own a share of that fund. If you want to get that money back prior to the 7-year holding period, the fund basically will give it back to you, but they give you back your shares. If you hold it past the 7-year holding period and now you want money out, they can give you back a diversified portfolio of all the shares. So it's a way to diversify if you're going to hold on to something long term, anyways. But it is a really cool way if you're going to do that to spread that risk out across a lot of other stuff. Now, the 7-year period is an issue. Secondly, there are some, this is going to be higher fees typically because these are partnerships and they're only sponsored by a few very large companies in the country. So these things are not readily available unless you look for them. And during that holding period, by the way, if you need cash, these things are not great for cash. So there isn't a liquidity issue. Now, it's not that you can't get cash. It's just that if you ask for a disbursement, they have the right within that 7 years to just disperse back to your individual stock. So maybe even if you just ask for 100 shares back, that's what's going to happen. You sell it, you still pay your capital gain. So exchange funds can be great for diversification, but I would say they've become a little less popular over the years just because of the rules around the 7-year holding and everything like that. So let's pretend if we had an exchange fund idea, but we could speed up that holding period problem. Let's pretend that's a better idea. And lo and behold, we come into 351 ETF conversions. Now, the similar concept applies to this as applies to an exchange fund. The difference is when you contribute shares to a 351 ETF conversion, what you're really doing is you're buying shares of an exchange traded fund. That's what an ETF is, an exchange traded fund. If you don't know what that is, think of it as another vehicle more liquid than a mutual fund because they trade all day long, but they have some tax benefits because they don't distribute as much tax as a mutual fund. The issue here is that you can only contribute shares into an ETF upon the creation of that ETF. So you can't just go out on the market today and look at, for example, Vanguard's S&P 500 ETF and say, I'm going to exchange shares of my Apple stock into that because I don't want to pay my Apple tax right now. But if Vanguard were to create a whole new ETF today, and there are other companies doing this, by the way, then you would have the opportunity at that point to exchange in because upon creation, you can do that. Now, there's some rules around this. Generally, the rules are in my gray box here that are a little bit of an issue, which is, first off, no single security can be 25% more than 25% of the ETF. So you can't contribute. If you had $1 million you wanted to put in here, only 250,000 of it could be in one single stock. That is a potential issue for people that want to diversify fast. Secondly, the top 5 securities you contribute have to stay below 50% of your balance. So ideally, here's what this means. You typically are going to want to contribute like 11 securities. Okay. Now, what's interesting about this, if you look behind the scenes, the look through on this is what's important because they're going to look at what you put in. But if you put in, for example, an S&P 500 ETF as one of the holdings, it looks through and looks at all 500 stocks in that S&P 500. It doesn't look at that as just one holding. And so this rule can be quickly mitigated by you using certain assets that might be other ETFs you just want to diversify differently. So I bring this up because the beauty of these is that we get no lockup period. So remember with an exchange fund, we had a 7-year lockup. With this, there's no lockup. the day of creation, your dollars go in via you give them your stock or your ETFs, whatever equities you want, let's say. They immediately create new shares of the ETF. The next day that's trading on the stock exchange, you now have liquidity. You could turn around and sell it. Of course, you'll pay your capital gains because you are putting in your basis, or you can hang on to it for a long period of time because now you've got a step up opportunity down the road when you die. I'll get to that in a minute. But in general, the ETF conversion is a cool new tool in the toolbox that does make exchange funds a little less exciting in some ways. However, if you have a large amount of stock, exchange funds can still work because of these rules around 25% and everything. So this is a cool way to get quick diversification because we don't have that lockup period. Finally, and this is a very similar concept to what I just described, we do it, except now it's called a 1031. But now we're doing it with real estate. And a lot of real estate investors already know this one. With real estate, you can basically take something where you've had a gain, sell it, and you have a certain amount of time. The windows are listed here in the consideration side. You have a certain amount of time to basically say, I want to roll the gains into a whole new property and and then I don't have to pay capital gains tax on that until I sell that property. So what I joke about with people I know that are in the real estate game is you never know how successful someone is at real estate until the very last deal they do, which is usually late in life, because that's when they actually pay all their gains. Now, one point, everyone asks me, can I do this with my house? And the answer is no. This is for commercial real estate. So please don't try to do this with your personal property because it doesn't work. But from that standpoint, anytime you're using something where you are renting, it's a focus of a business, this can be an interesting way to defer tax if you have a good idea. And that would be my one constraint here is if you have a good idea for another property. I've seen people that do this where they're so worried about paying the tax that they 1031 it into some of these new kinds of deals. I'm not going to get into it, but they're set up basically just to handle the problem, but they themselves might not be the best investment. So I do caution you that if the only goal is avoiding the tax, be careful that you don't let the tax tail wag the dog because the investment part might be an issue. Now you'll notice at the bottom, and I'm going to get into this as we keep moving forward here. I made a point in February's webinar about step up in basis, and that's something where I'm going to now jump to because that is an opportunity, whether it's 1031 exchanges, previously with that 351 ETF conversion, even with the exchange fund itself. Step up in basis concept is fairly simple. If you do anything at all with any of these and you hold them till death, at death, your estate gets a step up in cost basis. And so all the capital gain gets wiped away anyways. So this idea that we defer as long as we can does make sense because ultimately there are two ways to get rid of gain permanently. One of them is charity, which I'm going to get into, and one of them is that step up in basis where we just hand it off to the next generation. Now that doesn't mean that you don't have potentially tax due because you still could have income tax due, particularly if you're passing on like IRAs, 401ks, things like that. Secondly, you could have a state tax due if your state's large, whether it be at Minnesota's level or at the federal level, or if you're in a different state at one of those states. But if you look at it just for what it is, we can wipe out capital gains if we hold it till we die. This is a big discussion point because so many people these days want to gift assets to their kids. And I love it, and I'm in full support of it. I just want people to always be aware that when you gift assets to your kids, you're gifting your cost basis. and your kids now have to pay the capital gains tax. If you wait till you die, they get a step up in that basis and they don't have to pay capital gains tax. So that's your one issue to deal with there. And by the way, that's not a bad issue. Whether you should pay capital gains or whether you should worry about something at the end if there's a large estate is a math question. Because if you pay capital gains at 15%, or whether you or if you pay estate tax at, let's say, 16% or 40% or whatever the numbers are, depending on state and federal, that's the issue. You need to run the numbers to see which one's more advantageous. The other idea, and I'm going to jump into this first, is charity. What if we give strategically to charity? So let's jump into that. As you heard in my last presentation, never give cash to charity, always give appreciated stock. So appreciated stock is the easiest way to do this because then we get rid of the capital gains problem. The charity can sell without paying capital gains. The other two ways, though, that it's done oftentimes are through donor advised funds or charitable remainder trusts. There's other methods like charitable lead trusts. There's other things. I'm just using the two basic ones here. Most people these days use donor advised funds. The beauty of the donor advised funds is think of it as a brokerage account, but held by a charity. So when you put the money in, you get an automatic tax deduction for your fair market value. They sell the asset. They don't pay capital gains, so you don't have any of that issue. But now, because it's a donor advice fund, you get to give the money out over your lifetime, however you want. So what we see a lot of people doing with these is putting assets in large chunks to affect certain tax implications in certain years. And then in other years, they may not give much to charity from that perspective, but now they got a large donor advice fund where they can hand money out whenever they want. Also a great strategy, by the way, when you're trying to match up whether or not you take standard versus itemized deduction on your tax return. I talked about that last month, so I won't talk about that again. Donor advice funds get used a lot. Where charitable remainder trusts get used differently is that there are times when people want dollars to go to things they want them to go to that require let's just call it a certain amount of finesse. Donor advice funds can give money to any 501c3. Okay. So that's the side. But in a charitable remainder trust, theoretically, you could set up a trust that says, I want to hand out scholarships to anyone at this high school for use at a certain college. Okay. That's an opportunity you have with a charitable remainder trust that you don't have with a donor advice fund, because if you think about it, those individual students are not charities themselves. And so where trusts get used over donor advice funds is when people want to do things that are just a little more on the creative side, maybe. Whereas donor advice funds are used when people want to just give to other 501c3s, any other charity, basically. And that's the simplest way I can describe it. The other thing, though, and I'll just point this out at the bottom, is these do not take into account IRA money. If you have IRA money after age 70 and a half, you can do what's called a qualified charitable distribution, or QCD. That can be used to satisfy your requirement minimum distribution. And what that does is you can gift dollars up to 100,000 per person out of your IRA into a charity each year. And it's a cool way to satisfy your RMD, but it's also a cool way to give to the charities. It's different. You don't get the tax deduction because it's coming out of an IRA, but you do remove assets from your taxable estate. So it's a good way to do it. And quite honestly, we do that a lot for people towards the end of life because we want to deplete their IRAs as fast as possible, since those are kind of the worst assets to pass on to kids. But all right, let's look at some other ideas that might be even a little more advanced, but interesting. So now I want to get into how do we permanently eliminate things? This gets into a legacy issue. So when we talk about estate planning, what people kind of forget is they assume estate planning is all about getting their wills and trusts done. I've got it done. I'm done with estate planning, and that is actually just a start. If I can get anything across to you today, it's that everything I'm talking about is basically got to be put in place way earlier than the ultimate event we're talking about, whatever that event is. If you don't do it early, if you don't do it consistently, if you don't follow the right structure, you get yourself into trouble with these things. So, from our perspective, let's talk legacy. Here's a couple of strategic ideas. One is asset location. Going back to what I just said about the step up in basis idea, if you are going to try to get a step up in basis, then the one thing you want to probably do is hold as much of your growthier assets in standard brokerages accounts and as much of your bonds and low growth assets in your IRAs and 401ks. Because at the end of the day, you want the growth stuff to get that step up in basis because that's going to be a bigger pile of money. And then you want the IRA to hold the stuff that maybe not growing as much because you don't get a step up in that side. But just to come back a second, this also makes sense from two other scenarios. One is the IRA gets to have, let's say, bonds kick off income. Income in an IRA does not flow through to your tax return, so you've avoided some tax issues throughout the years. Secondly, if you don't grow your IRA as much, I'm not worried because I look at your household, and as long as we have growth assets and more fixed assets in the right spots, the whole household's still doing what it needs to do. But at death, we're handing off the lower balanced accounts, hopefully IRAs, to your kids, and that's done and I want a lower balance because they have to take that money out over a 10-year period, and therefore that kind of jumps up their tax brackets. So to me, I'd rather grow the assets the fastest in the just a standard brokerage account because I'm going to get a step up in basis and then put the non-growthy stuff in your IRA. So that's kind of one and two on the slide. And then three is that there are certain trust structures that can maximize that step up opportunity across generations. So I'll step into that in a minute. Let's talk about 6 more tools that basically help defer, but potentially can lead to elimination long term as well. And this is where I want to get into some detail. I'm not going to spend a lot of time on 1 and 2 because 3 is a little bit of that. So where I'm going to focus on is more 3, 4, 5, and 6. Okay. 1 and 2 are simple. Tax loss harvesting is a basic understanding here where we take winners in a portfolio and sell them and pay the capital gains when we can offset them with losers. And that may sound counterintuitive, but every portfolio has losers in it typically. So we're trying to make sure that we always are looking at what are the opportunities to harvest losses. That's the general premise here. So let me jump into 3, 4, and 5 in more detail. And I'm going to go to the next slides for that because each of these has a slide I want to spend time on. First, a tax overlay strategy. This takes what I just said about selling losses and elevates it. Generally, what we see, if you think about it, is someone's going to hold their assets, and let's just pretend they have $1 million. And by the way, this strategy works for people with $1 million or more. This strategy, you have to have a minimum of $1 million to do this even. But basically, what people do is they hold their portfolio. It goes up or down, up or down, up or down, right? And over time, we know this. If you hold something for 10 years, 20 years, 30 years, most of the time it's up. Well, what this does is put this overlay on it where you can hold the asset. So let's just call this the S&P 500. fund that you own. What we do is we basically add margin to your account and use the margin, borrow against that. And what we're doing is we're going to buy 30% more of that. So we're going to buy 30% more in stocks, let's say, of the S&P. And then we're going to short 30%. And so what you have are these extensions where you've got your 100% performance because you own the S&P 500. And you got 30 long, 30 short, which means if the markets go up, your long position does well, your short position doesn't. So we sell some of the shorts to create capital losses. If the market goes down, your short position does well, but your long position doesn't. So then we sell some of the longs to create capital losses. With this strategy, what you're doing is you're always creating capital loss depending on which direction the market's going. And it's a way for us to harvest losses actively on an ongoing basis. Whereas most portfolios after 6, 7 to 10 years, what we would say are atrophied, meaning the market keeps going up. And so they just lock in capital gains and they just don't have as many losers anymore. This strategy allows us to create losers basically forever. And so what we can do now is we can do a couple of things. If that S&P 500 is a fund you want to hold and we never want to sell it, great. We'll have losers. We got market returns. We're happy. The losers can be banked and we can use them sometime in the future. So let's say sometime in the future, you're selling something else, whether it be a piece of a property, a business, or even just stock in your portfolio for something else. We now have losses on your tax return because you carry those forward forever that we can use against that capital gain. So we can do that. Second thing we could do is if you have, take away the S&P 500 as that middle sleeve. Let's say you have a concentrated stock with a lot of capital gain to it. You could put that in there. And we could say in the strategy, we could say, we're only going to sell that stock to get rid of it when we have losses created on those two extensions, because we want losses to offset gains. So maybe over the next 4 to 7 years, we get rid of the stock altogether with very little capital gain at all, because we create enough losses to offset gains throughout the years. There's different ways to use this strategy. I'm giving you a couple. This is a really cool idea, but this is one of those strategies where, again, you really want to work with someone in doing this because this is not, it is complex, but it's cool. So just a heads up to that. Second idea, give to get back. Now this only works in certain scenarios, but here's where I'll give you an example. If, let's pretend you have parents or grandparents, let's say they're in their 80s, maybe even better in their 90s, and you know that they're getting towards the end of life, and their tax situation is such that they're not going to have any kind of estate tax due. This can make sense where if you have children, maybe even grandchildren, I suppose, in high tax scenarios where they're holding on to appreciated assets, what we may want to do is gift them to the parent or the grandparent. And then when the grandparent or parent dies, they get a step up in basis. And then the estate gives it right back to the child or grandchild. And now they get that step up in basis. So they get their money back and all the capital gains wiped away. Now, this is a strategy that can work in a couple different ways. I'm not going to get into the different ways right now, but basically, this can work where the couple of things you have to keep in mind are A, if you move it up to the parent or grandparent, they have to survive a year with that gift, not the 3-year rule, the 1-year rule. The 3-year rule is about who gave the money. The 1-year rule is about they have to survive at least a year. Otherwise, that step up doesn't occur. That's a big issue. So you don't want to do it for someone who's literally on their death. The second scenario, the second thing that I'll point out is You still need to worry about estate tax concerns, usually at the state level. So, for example, if mom and dad are here in Minnesota, and let's say they have, um, well, let's just say mom and dad have some money. Let's say they already have $6 million. At the state of Minnesota, each person can have 3 million in their name. Let's say that's perfectly balanced. Mom and dad each have 3 million, so 6 million combined. If you then, as a child, gave them $1 million of appreciated assets that you want them to give back to you, you've now elevated their estate to 7 million. And in Minnesota, that would actually trigger a tax on their death that probably costs you 15% roughly. Um, so did you really accomplish what you wanted to? No, because you wiped out capital gains of 15% so that you can pay a 15% estate tax. So where this works best is when mom and dad don't have a lot of assets, or where mom and dad are in another state that has no estate tax issues, and we do run into that a bit. So just keep in mind there are different things you got to put together here. And this is one of those strategies where I always encourage you spend time with your advisors, your estate lawyer, everybody involved, because you do need to make sure this is done correctly. The third scenario, hold, borrow, and die. I won't call it what it is, but to be fair, this is what a lot of wealthy people do. What they do is they look at their appreciated securities, and instead of selling them, they do is they just hang on to them, and they open up a line of credit against the securities, borrow against them for their spending needs, and then when they die, they get a step up in basis, and then the estate pays back the loan with those assets, and whatever's left goes to the kids. But since they got to step up in basis, they come out ahead. Now, if you're using margin to borrow, can have liquidity issues if things tank. Um, there are other ways to do this if you think about it. You could borrow via a home equity line of credit. You could borrow through margin. You could borrow through collateralized loans against the against your assets. So there are other ways to do it. It doesn't have to be margin, but just keep in mind the different ways that you do it. You could have other issues. So, but this is a legitimate way, and especially later in life, this should be thought about. I've seen scenarios where people are in their last year or two of life. They have large concentrated holdings, and they make some big sales because they're trying to do something, whether it's pay for healthcare or whatever it is. And they create a big capital gain tax, and then they die like within the year. And they could have gotten a step up in basis on all that money. So that's where I see stuff like this being especially powerful. Like if I were 50 years old, would I start borrowing? I'm not suggesting that, although that is the way Elon Musk does it, but I'm not suggesting that. So just a way to think about this differently. I'm going to throw in one last one that is unique here. This is unique because going into 26, we weren't sure what this looked like. And now the one big beautiful bill changed it for us. So qualified opportunity zones are interesting. What it does is you sell an asset that you're going to have a big capital gain on. You reinvest the proceeds. Think of this kind of like that 1031 exchange for real estate. If you reinvest the proceeds in a qualified opportunity zone, you can delay paying your tax. And really what it is in 2026, we're in a dead zone. So do not do this in 2026. But starting in 2027, and I say that because 2026 was the end of the last law. So we're in a bit of a gap here. And the new law starts January of 27. But the way it works is you just put all your proceeds into the new qualified opportunity fund. And by the way, typically these are going to be real estate investments. The qualified opportunity fund, which is really a qualified opportunity zone, as long as you hold the money for at least 5 years into that fund, 10% of your gain is permanently eliminated. So let's say you put in $1 million of gain, 10% or 100,000 of that is permanently wiped clean from your from your tax problem after a 5-year hold. And if you hold it for 10 years, 100% of it's wiped away. The middle point I'll point out here is that the 30% elimination after 5 years works if it's a qualified rural opportunity fund. Rural is the key word here. So think of going to some small city somewhere in, the rural hinterlands of Minnesota that has one of these. Might have a shot there. Again, it should still be an investment decision first and a tax decision second. So be careful, but that's a little different. The second thing, and I already said this, since they're real estate investments, you may not want to do everything in this, because if you took something that's a high growth asset and you want to keep growing it, dumping it into one of these, because it's real estate, it may not grow as fast. So just keep that in mind as well. They are a little more complex, so keep that in mind. And you do have illiquidity for a long period of time. So something to consider. Throw it out there. Finally, to talk about estate level issues specifically, because trusts were mentioned earlier, I want to just point out these different kinds of trusts that you can use to do different things. So a grant or retained annuity trust does allow you to basically do something different, where you put in, let's say, a high growth asset where you think it's going to grow a lot over the next 2, 3, 4 years. What these grants do is they literally are put in place for that short period of time. And they'll literally say, pay me my money back 2 years from now, which means each year you got to give me 50% of the trust back. So 50% after year one, and the last 50% after year two. Whatever growth is on top of that gets to stay in the trust and then go on forever to the kids or grandkids. So if you have a high growth asset, there are ways to maybe grow it outside of your estate, but you are still taking it back into your estate from the standpoint of the corpus. People will do these in stages where they'll set up 3, 4, 5, 6 of these in different time periods to try to get this rolling GRAT idea going. It is an opportunity yet. Again, Congress constantly talks about restricting these. They haven't yet, but that is an issue. Keep in mind. Second, spousal lifetime access trust, or a SLAT. Basically, what you do is you set up a trust. It's an irrevocable trust, meaning once you put your assets in, you can't take them back. But what you do is you put them in and you say, my spouse is my beneficiary. If they ever need the money, they can take it for whatever reason. Now, what you're doing is you're getting the assets out of your estate. So this works best for people that have estate problems, meaning if you have assets between you and your spouse, because you each get a $15 million exemption, more than 30 million, these things can be something to consider. Or if you're approaching that 30 million and you're young, these things can be something to consider, because you still got a lot of life to live and your assets will keep growing. Here's the negative to these. The negative is you just said, because it's an irrevocable trust, I give this money to my spouse and they can use it however they want. Therefore, if they divorce you, they still get it. So keep that in mind. None of us like to talk about it, but that does happen. Charitable remainder trusts, I already mentioned a little bit, so I'm not going to get into that. And then finally, family limited partnerships. These sometimes are used in unique ways. Easiest one, here's an easy way to describe it. Put something in it. So let's pretend it's a family cabin, but you could put in anything, to be honest with you. It could be stocks, could be anything. You put in a family cabin, and then what you do is you gift shares of the family limited partnership to your kids. But when you gift shares to them, because they don't have majority ownership, you can give them those shares at a discount. And the discount will depend on what your accountant says. Depending, you can get 20% discount, maybe up to 40% discount. But if you think about it, what you can do is you can give more of your assets away quicker because you get a discount. And so sometimes these are used as a gifting strategy to pass the assets on to the children and grandchildren faster. All right, we're nearing the end, so if you have questions, make sure you throw them my way. As we near the end, there's still, I just bumped something. Oh, I just lost my, that's funny. That's really funny. I didn't bump anything. PowerPoint closed and reopened, so I got to go find the slide I was on. Here we go. Um, I mentioned this before, but gifting appreciated assets is something people do, and they have to do the math behind whether they give it to their kids and have their kids pay capital gains or whether they wait and get a step up in basis at death. But if you want to give to your kids or your grandkids, there's different things you want to think about. So oftentimes what we want to do is give away the tax problem to the kids because they may be in lower tax scenarios than we are. And so giving them high growth, low basis assets makes sense oftentimes. You do need to go in and pick, like when you go into a brokerage account, a lot of people's brokerage accounts are set to average cost basis, and that's not the way you do this. You actually want to go in and be able to pick the exact lot to give away. Not all brokerage accounts do this very easily. So I'll just give you that tip. That is an issue. But anyways, high growth, low basis assets are the best assets to give sometimes because you want to give away things that might grow fast continuously, therefore get it out of your estate. And you're giving it to someone in the lower bracket. If you give away the assets you want to keep are more lower growth, think bonds and maybe even real estate, things like that, and things with high basis, because it may not matter as much. Now it's the exact opposite strategy, by the way. What I just said could go the exact opposite. If I have a strategy where I want to get a step up in basis because I don't have an estate tax problem, I might want to keep my low basis stuff because I'll get a step up in basis. The kids will get it then capital gains tax free, but also if I don't have an estate tax problem, estate tax free. So it could be more beneficial that direction too. But just something to think about when you're thinking about how you want to gift. This is kind of a summary slide of everything I just talked about. So think about where your situation sits. And depending on your situation, there might be a strategy that applies to you on the other side. It could be that there's even a mix of strategies. And I think that's my biggest message here. The biggest thing that people kind of get stuck on is, I want to do this or I want to do that. The reality is usually it's a multitude of all these things we want to do combined that has the best benefit for a situation. So whatever you do, don't get stuck on whether or not one thing is a good thing. It's usually a multitude of things. And here's 3 things that can cause you to fail. A lot of what I've talked about today is complex stuff. Structure matters in this stuff. So we do want to worry about compliance. If you are not a disciplined individual, you got to have someone working on your team who's going to help make sure this stuff is not just dealt with on the front end, but on an execution perspective. Annually, there's some things you may have to do to make sure they work right. Got to have someone who knows what they're doing on that. Secondly, timing matters. Some of these things need to be put in place even years and years ahead of when you actually have a problem occur. For example, if I create a bunch of capital losses today and I don't need them, but I bank them for my tax return, and then 10 years from now, I sell the family cabin and I got this big capital gain. Now I got losses to use against the capital gain. If I am going to sell the family cabin and I say, oh, I got no losses, I should go do this strategy. It's too late. Like I can't create enough loss. So timing is a huge deal with some of this stuff. And especially when we talk about estate planning, because timing matters with estate planning, depending on if you have to live past the 3-year window and all this other stuff. So timing can matter a lot. And then third, this idea of liquidity mismatch comes up a lot too. So I threw it on here because some of these strategies do lock up capital. So the one thing that I don't want people to do is run out and do one thing and say this works for everything. Oftentimes, when we talk about some of these strategies, we might only do it on 10% of their portfolio or whatever that looks like as a way to make sure that there's still plenty of liquidity and other things in place. Okay. Finally, state residency matters for some of this. So keep that in mind too. Um, for my friends outside of Minnesota, quite honestly, there are other states where some of this stuff is even better. So I will leave it at that. With that, I want to thank you for attending. I'm not seeing any questions yet. I will close with reminding you that we did launch a podcast. The most recent episode is up. It's actually most recent episodes on a great interview on the economy and stuff. So feel free to listen to that. Next month, I'll be coming back with our quarterly economic update. So we do that every quarter. For those of you that have seen it, you know what to expect, hopefully. We'll talk a lot about what's going on and who knows if we'll still have some of the issues internationally, but we'll get into that. Seeing no questions, I want to thank all of you who attended. I appreciate that. And if you have any specific questions prior to next month, feel free to reach out to me. And you can even go online if you want, not just to register, but online if you want to go to my bio and schedule a meeting with me, you're welcome to. So with that, have a fun day, and I wish you the best. Bye-bye.